Let's broaden this out now to the markets and your money. Joining us now is Krishna Memani. He is former vice chairman of investments at Invesco. Krishna, good morning. Welcome. Okay, so as a longtime viewer and user of this product known as CNBC, I know that you were one of the first bulls out there. You were long, strong, and you've been right.
Yes.
Do you stay that way after a doubling in 7 years?
So I think the answer is still yes. So the risks have clearly gone up for multiple reasons. One, valuation is better, or valuation is worse, valuation is higher. At the same time, growth rate is actually moderating, and then we have this coronavirus to deal with.
Yes.
Having said that, the fundamentals, the things that drive markets, such as revival in economic growth, policy support, balance sheet expansion, all of that is still very much in place. So until things get really bad from a surprise standpoint, these are known unknowns that we are dealing with.
The known unknowns. Steve, so Krishna's points, number 2 and 3, behind doors 2 and 3, lie your world, the Federal Reserve.
Yeah.
Policy support and balance sheet expansion.
It has gotten to be kind of bold here. The market, to my mind, is out on a limb. We'll be talking to a bunch of Fed folks coming up, not today, but in the next couple of weeks.
Market out on a limb in what way?
I am looking at a 50% probability of a cut in July. And then that ramps up to a 78% probability by December. And they have started, I hate doing the math live on television. I looked at this earlier this morning. Put it this way, they started the price in a second cut this year. That is very aggressive. I don't know how much the market needs.
Why do you think that's happening?
It's SARS. I'm sorry.
No, I know it's coronavirus, but why?
Yeah.
I think part of it is coronavirus, but part of it is still that the inflation pickup that the Fed has been expecting for 10 years really hasn't materialized. So if there is a significant drawdown in inflation without any significant drawdown in growth, it makes sense for them to cut policy rates. And I think that's what the market is expecting. And the one thing that we have to remember in this cycle, the markets have been more right than the Fed in calling these turns.
Krishna, can I ask a personal finance question?
There's a self-fulfilling prophecy here, too.
Yeah.
That they forced the Fed into it.
That they forced the Fed.
Well, I will tell you that Mary Daly yesterday, one person on the FOMC told me that she's, in so many words, said, I am not ready to do another cut based on the information I've seen from the coronavirus. I want to ask you a personal finance question.
Yes.
Okay.
I'm here to answer.
My financial planner called me, said because of the stock gains, our agreed upon bond stock split has gotten out of whack. Mm-hmm. We were all of a sudden...
Is this a real story?
It's a real story. All of a sudden it's 70-30, and he wants to cut it back to 60-40, which is where we want to be. Mm-hmm. Is that a smart move in this market?
Well, so if your benchmark is 60-40, then I would say...
Getting back to the benchmark
so I would say that you're probably better off 65-70 rather than 60, because I think the higher probability is that the markets still go up because
you want a higher...
Equity allocation. Absolutely.
In this market.
Absolutely.
But
how high?
Well, I don't think it needs to be 80, but I don't think it needs to be at 60 either. But the trick, because of all this unknowns that we are dealing with, is you probably have to have an itchier finger than you probably have had at any point in this phase.
I'm not allowed to do half of this stuff. I just have to follow these big, strict regulations we have here at CNBC, but I can rebalance my portfolio every now and then. So, if that's your benchmark, go back to it and stick to it, is what you
Yes, I would say, slightly higher allocation than your benchmark into equities is really the right strategy at the moment. Yeah, well, please do, and I'll charge a fee for that, too.
Okay, but the answer, though, you think is that this has a long way to run?
The market still has a long way to run unless it gets derailed by something like coronavirus. But as your previous guest was saying, the impact of that, if we can find a way of containing it even if you get a contraction in China in the first quarter, actually is not going to be substantial because the capital stock is not getting destroyed.
What I don't understand, Steve, about your financial advisor, whoever this person is, I'm sure they're a genius. My financial advisor is a genius. This is a guy named Brian Sullivan.
Yeah.
And I'm 48, okay? I'm 100% equities in our 401k. I got the gas pedal down.
Yeah.
I don't see any reason to own bonds. I can't.
Well, you just got a little juice, this whole thing that just happened.
Why not just have cash? Why not just have cash?
If equities fall, then the money goes into bonds, and you do get a little upside when that happens.
I will say I'm getting a little nervous.
I think if there was a case to be made for owning cash as opposed to bonds, this is probably the time when that cash over bonds. This is probably the strongest case to be made
right now.
Yeah.